Hi everyone, welcome to my channel. In today's video, we'll be looking at the Fed rate cut decision and which sectors could benefit from this Fed rate cut decision. And we'll also be looking at some of the facts like how the markets have reacted. So let's get started. The first one, we'll look at the facts about the Fed rate cut, that news that came yesterday. So this is the Fed has cut the interest rate by 50 basis points. And this is the first rate cut since 2020, and it concludes one of the Fed's most aggressive campaigns against inflation since the 1980s. So this is the first of the many rate cuts that are expected. So the markets have like, as we always say, the markets are always forward looking. The market was expecting either a 25 basis points or 50 basis points. So the 51 came as a little bit of a surprise, but the market didn't react much. Maybe it has already factored that in. And now what we would be looking for, what to watch out for next is the speed of rate cuts. Like when is the next rate cut? And there are two more additional rate cuts, around 25 basis points that are expected within this year, and further reductions in the interest rate are expected in the next year as well. So this is what the market is expecting. So if there is any surprise in these numbers, like if it's more than 25 basis points or anything, then we could see the market rallying. There will be a lot of volatility. Like if we look at the past instances where the Fed has started with the interest rate cuts, we have always seen a lot of volatility in the initial 1 month, in the initial 100 days, that is 3 months. So this is the most important thing to watch out for is what is the speed at which Fed brings the next rate cuts. So that is the most important thing to watch out for. And let's look at how the markets have performed post the rate cuts. Like we are looking at S&P 500, Nasdaq, Russell 1000 and Russell 2000. We can see that in the first 3 months, they have performed a little bit bad. And over a 6-month period, they have all performed in a positive way. And over a 1-year period, almost all the indices have been better off or have moved up in the right direction. But what is common is that almost all the indices, like even the global indices, like the Indian markets or the emerging economies, in the first 3 months there will be a lot of volatility, but the 6 months and 1 year after the rate cuts have always been better off. So this is something that we can expect, but there is no certainty in the markets. This is what has happened in the past, and it's showing that this is what is most likely to be happening. But if there are like recession fears, or if the US enters into a recession, then we might see a different scenario being playing out. But this is based on averages, like based on what has happened in the past since what has happened when the Fed has cut the interest rate since 1972. So the initial 3 months doesn't look very rosy, but after 6 months and 12 months, the markets or the major indices have always been in a positive territory after the first rate cut. So that is what is the most important takeaway when we look at the past. Now let's look at some of the sectors that can do well when the Fed actually starts cutting the interest rates. So the first one is obvious. So the majority of the middle class, like they would use this opportunity to get into real estate. Like we might see like REITs and real estate stocks, real estate related stocks like builders, mortgages related stocks will do well during this period, because it is now cheaper to borrow than it was like in the past few months. So there will be real estate stocks will be doing well. The next one is when technology stocks will be doing well. This is where like technology related companies and growth specific companies would use the cheaper cost to borrow capital to grow at a faster pace. Like the growth comes at a cheaper cost now for them. It's cheaper for them to invest in capital expenditure, like building the infrastructure for AI, like the cloud players and the software companies that have a huge margins. Like they will be investing in AI infrastructure, like Nvidia, these kind of things. They would be much more aggressive in focusing on their growth. So technology companies will do well, and growth, that is especially the growth companies. The next set of sector that will do well during this kind of situation where it is cheaper to borrow money is the financial. It's obvious, like banks and financials, like people who will lend money, they will see an increase in the lending activity because it is cheaper to borrow. So there will be, like, the technology companies would be, and the common people, like, they would be borrowing money to spend, so, and to invest as well, like so we can expect the banks and the financial services, especially those in the lending business, would be doing well in this environment where it is cheaper to borrow capital. The fourth and the other obvious sector that will do well is the consumer discretionary stocks, because we are expecting the spending to increase, because the people, it's cheaper to borrow capital now, so people will be borrowing and then spending. It is so whenever the interest rate drops, the spending activity actually picks up. People might be taking out loans to borrow, like buy a car, or like there will be more allocation to discretionary spending. So we might see consumer discretionary stocks and consumer goods related stocks also doing well during these phases where Fed has cut the interest rate. Now, the most important thing is, what as investors we need to focus on, is to focus on growth companies, because as we can see from here, this shows the 3-month, 6-month and 1-year returns after the Fed has started the interest rate cuts. This is for a shorter time frame, like post 1990. We can see that Nasdaq, which is mostly composed of tech and growth companies, has done exceptionally well because it is cheaper to borrow when the Fed starts reducing the interest rates. And we can also see that other growth indices, like the Russell 2000 growth and S&P 500 growth, as well as Russell 1000 growth, have all done well because it is now cheaper to borrow capital and then invest that capital in growing your company, growing your revenues, and then expanding your operations. So the key thing to take away from the implication of Fed rate cuts is, as investors, is for us to focus on growth and growth related companies. The obvious thing is that it's cheaper to borrow capital now, so companies will be borrowing this capital to expand there. So yeah, that is the most important thing. Like we can see here, in the 1 year after the Fed has started cutting the interest rates, the growth companies have really done well, and we can expect a similar trend to follow in most of the indices as well. Thanks for watching this video. Please do consider subscribing to my channel and sharing if you found some value in this. Thank you.